Okay, so moving on to the final part of this little screencast trilogy, I guess. So the principles govern the recording of information. This is what we've talked about previously. So principles, how accounting information is recorded. Okay. So reports are then prepared under the guidance of what is known as it's the international framework. But the international framework basically identifies um, the qualitative characteristics that all accounting information needs to have. And those four qualitative characteristics are relevance, reliability, comparability, and understandability. So all reports that we produce need to be relevant, they need to be reliable, they need to be able to be compared, and they need to be understood by everybody who is going to use those reports. The first one we're having a look at is relevance. Basically, what relevance states is that all reports should include all information that is useful for decision making and exclude any information that isn't. And as it says here, this characteristic really is just telling us what to include in our reports, which basically will be all the information present if we follow the entity and reporting period principles. See how we're linking the principles with the characteristics. So we've got a situation here where if we follow the entity principle, meaning that all transactions to do with the business are included. And we also follow the reporting period, meaning that all transactions are reported in the period in which they occurred. Then what should happen is that our information should be relevant. So just go through that again. If we follow the entity principle and we follow the reporting period principle, then our qualitative characteristic of relevance should be covered. So it goes on to say that when we're preparing the balance sheet for the business, obviously personal assets aren't relevant because they're not to do with the business. Similarly, the income statement should only include the revenue and expenses from the current period. So anything that happened in a previous year's period, so for example last year's wages or next year's sales figures, is not going to help us make decisions for this particular accounting period. This last little piece of relevance is also important as well. This concept of material. So this means information that is regarded as material. Information that is material basically means that if it was excluded or it was recorded inaccurately, it would affect the user's decision making. And it basically refers to the level of detail that we need to include. So for example, this is a really good example. The debtors obviously must be included in the balance sheet. However, the information in terms of every single debtor and what each debtor owes is not information that's going to affect decision making. So it'll just make the report more difficult to read, and therefore doesn't need to be included in the balance sheet. although the debtor control or the total debtors needs to be included. Okay, moving on to reliability, and this one states that reports should contain information that is free from bias and thus can be relied upon accurately. Okay, so this one, Mick, this one relates, well, Mick and everybody obviously, relates really closely to the historical cost principle, because this is the best way to ensure that the information included can be verifiable via a source document and is free from bias. So here we can say historical costs ensures that we can verify our information. I'll move that up here. Second last one we've got here is the comparability concept or characteristic. Now this basically means that, again, we just need to be able to compare reports between different companies and obviously between reporting periods for the same company. And this basically cuts to the one of the most important or basic uses for accounting reports is to be able to compare between businesses and compare between periods. So if the accounting methods aren't consistent, then we're unable to compare. So this one basically relates to monetary unit and consistency. Okay, and last and certainly not least, understandability. It basically states that accounting information needs to be made easy for the user to understand the meaning. So because most small business owners aren't accountants, we need to make sure that our reports are presented in a way that is going to make it easier for them to understand. So it might be more effective, instead of presenting in reports, it might be more effective to present information in graphs or tables or charts, and in simple language that is free from accounting jargon. So what I want to have gained from this exercise, gentlemen, is that we can really link our qualitative characteristics to our accounting principles, and if we're following our accounting principles, then we're not going to have any issues with our qualitative characteristics. So look, if we can quickly just knock over review questions 1.4, and then there'll be some exercises for us to do later in the double. Thanks for your time, and we'll catch you on Wednesday.